Hello, ladies and gentlemen. I am the Acca tutor, Jeremy Tukulu from Transcar Consulting Services. I welcome you all to this short lecture on Acca AA Audit and Assurance, in which we are targeting the aspects of review and reporting and issues to do with subsequent events. Okay, I'm very confident you're going to be helped by watching this video as you are heading towards your exams next week. This last minute preparation might actually help you to prosper in your studies. I'm quite aware that there are a lot of materials out there that are being used by every student, every Acca student using them, which is fine because you just have to expand your nets wider so that you are helped as you enter into the exam room. Okay, so without wasting much of your time, please just go straight to business. Now, we want to talk about the audit report, because by the end of the day, when auditors are hired, they have to do their audit. After doing their audit, they have to report their audit. Okay, they have to report on what they have found. All right, but remember, in all these things, we are guided by the assurance engagement tags. Okay, remember the concept of assurance. Okay, where we say that the assurance engagement. Well, let me just have my pen. What's going on with my pen here? Okay, the assurance engagement. Remember, we discussed about 5 elements. Okay, the 5 elements. 5 elements, which were number 1, three-way relationship. Number 2, we talked about the suitable subject matter, then applicable criteria, evidence, then the report. Okay, now in the case of any audit engagement, in this case the assurance engagement here is the audit. Okay, but all those 5 elements should be present. All right, and we say that the three-way relationship here involves parties like the user of the report, the preparer of the not of the report actually, but the preparer of the subject matter, somebody who is going to prepare something. For example, the financial statements. All right, so for financial statements, the preparer should be the board of directors, the directors of the company. Directors of the company, they prepare financial statements, but these financial statements are then checked by the practitioner, and this practitioner is none other than the auditor. Okay, that one is covered. All right, then the suitable subject matter, this is that thing we want to be checked. Okay, in this case, there might be financial statement, there might be the financial performance of an entity, there might be some internal internal controls which should be checked, or the environmental policy, or the corporate governance state of the company, whatever that is needed to be checked. All right, but it should be suitable, something that is capable of being audited. Okay, it should be something that is capable of being audited. Then the applicable criteria. What benchmark are we using? Are we judging the subject matter based on IFRS, the Companies Act, or what? What are we using? How are we assessing the subject matter? That's the applicable criteria. Okay, and in the case of audits, for this paper, we are presuming that the entities involved are using the IFRS. Okay, they are using the IFRS reporting framework as well as the Companies Act in the jurisdiction in which they operate. Then, when we talk of evidence, ladies and gentlemen, in an audit, the evidence should be sufficient, appropriate audit evidence should be gathered. Appropriate audit evidence should be gathered. Then lastly, after you do everything, you then have to report. Okay, this is where we are now. Okay, this is where we are. All right, the report. The practitioner has to speak his mind through his report. Now, two types of audit reports. There is what is called an unmodified audit report, which says that the financial statements are true and fair, and the auditor does not use any additional communication paragraphs. This is actually a clean report. A clean report. Okay? Then we've got a modified audit report. These are two types. They are in two types. Okay? Excuse me. Alright, we have got a modified audit report without modifying audit opinion. Here, the financial statements are still true and fair. However, we have got a paragraph like the MEG paragraph, where all disclosures have been appropriately made by the client with regards to the going concern issues. MEG is material uncertainty related to going concern. So, if the company has made all the necessary disclosures, then the MEG paragraph would be put by the auditor just to bring attention of the users, so that maybe the users would understand the issue better. Okay, they would understand it better. So it's more like we want to amplify. Okay, so it is put just below the basis of opinion paragraph, but it will not be modifying the opinion. No opinion is being modified, but the audit report itself has become modified because a clean sheet audit report doesn't have those MEG etc. Okay. There's also an emphasis of meta paragraph. Okay. This shows that something in the financial statements need to be highlighted. Okay, which is not related to going concern, something else, okay, has to be highlighted. The matters are of such fundamental importance to the user's understanding of the financial statement. For example, potential litigation outcome, significant subsequent events, etc. Those would need an emphasis of meta. All right. Excuse me. All right. Then, at the meta paragraph, the auditor would want to highlight something not in the financial statements, for example, an upcoming accounting standard or health regulation. Just alert the shareholders to be prepared of something that is being proposed either by the government or by the IFAC itself, okay, or by the IASB, right? The IASB, the National Accounting Standards Board. Sometimes there might be, there's a looming accounting standard that's coming, and it might be having some adverse impact on their operations and everything. So the auditor might feel that they need to know. The shareholders have to know beforehand. Okay. Sorry. Okay. Now there is another modified report. Modified report with modified audit opinion. Okay, modified opinion with modified. This is just a misnomer. The typo. Modified report with modified audit opinion. The first situation here is when we have got evidence at our fingertips. Here we have got two situations. It's either we are going to have a qualified opinion, okay, or an except for opinion. Sometimes just call it an except for opinion, where we are saying that financial statements are showing a true and fair view, except for these other facts, or except for A, B, C, D. All right. Then we can issue an adverse opinion. Financial statements materially misstated, and misstatement is so pervasive. In this case, we are saying that the financial statements are not showing a true and fair view. Why? Because they've been materially misstated, and this misstatement is pervasive. We can't rely on those financial statements because of that misstatement that is existing there. All right. So this is the FS are bad. Okay, so that's the first situation of modification, where we are saying that we have got the evidence is there, all right, but because of the evidence available and the fact that the financial statements are misstated, we are going to issue a qualified opinion if the misstatement is not pervasive. However, if the misstatement is only material, but is both material and pervasive, then we are going to issue an adverse opinion. Here, the financial statement, the misstatement is material, but not pervasive. All right, that's the thing here. Now let's just go to the second situation. In this case, there is no evidence. We don't have evidence. Okay. Okay. In this instance, we are having two possibilities. We do not have the evidence, right? Good. So we are then going to have the qualified opinion or a disclaimer of opinion. Now, for the qualified opinion, we are saying that we have been unable to obtain sufficient appropriate audit evidence, and the lack of that evidence is a significant factor. Actually, it's material. Okay, the lack of that evidence, or the inavailability of the evidence, or the evidence that is being required, is so significant in terms of money. Okay, significant but not pervasive. It's material but not pervasive. Okay, so in that situation, although the inability is significant, we can as well continue to issue an opinion which says that the financial statements are showing a true and fair view, except for that matter. Okay, so in this case we are saying the inability to obtain sufficient appropriate audit evidence is material but not pervasive. All right, but in this case, the disclaimer of opinion, the inability to obtain sufficient appropriate audit evidence is both material and pervasive. All right, so we can't just issue an adverse opinion in those situations, or in that situation, but we issue what is called a disclaimer of opinion. Alright, because we were not able to obtain the evidence, and such inability was both material and pervasive, then we can't give you any opinion. Alright, we can't give you an opinion. So we just have to mention that we are unable to give an opinion with regards to the financial performance, financial position, and cash flows of your company. So, forming an opinion. Alright, we talked of the unmodified opinion. Unmodified opinion, this is the clean sheet opinion. Alright, which says that the financial statements of the entity are presenting fairly in all material respects the financial position, financial performance of a particular entity. So they are showing a true and fair view. Alright, that's an unmodified opinion. But the contents now, we just have to know the contents of an unmodified opinion report, where we are saying that there should be a title, addressees. Usually these are the shareholders of the company. Okay, then the opinion. You start with the opinion. This is the recently and the required standard for now for an audit report. The opinion should be at the top. Then followed by the basis of opinion. Then key audit measures. This one is for only listed companies. For listed companies, non-listed companies can follow suit, but it's not mandatory. It is mandated for listed companies. Other information, this is the chairman's report, okay, etc. Then responsibilities of both parties, the auditors and the directors of the company, right? Then the signature, date, address. Alright, now unmodified opinion with additional communication. We talked about that, okay, where we are saying that we have got paragraphs like the make paragraph. Okay, this one is just below the basis of opinion paragraph. Then there could be an emphasis of matter, which is also below the basis of opinion or the make paragraph. Okay, sometimes some companies the make paragraph is in some audits is not going to be there. Okay, it doesn't mean that in every audit report you just have to find the make paragraph. The make paragraph is only there when there is need for it to be there. Okay, then the other matter, okay, will follow below that. All right, now forming an opinion. Okay, this actually gives us a more clear picture about what we've covered so far. All right, where we are saying that the modified opinion has got the modified opinion will affect two situations. Okay, will affect in a situation where the financial statements are materially misstated. Okay, are materially misstated, which means that there is evidence. Okay, there is evidence. There is evidence for us to claim that, oh, they are actually materially misstated. So in that case, we then have to ask, is it pervasive or not? Okay, if it is not pervasive, just issue a qualified opinion except for opinion. However, if the misstatement is both material and pervasive, then you have to issue a modified, an adverse opinion. You then go to the other situation where there is no evidence. No evidence. If there is no evidence, then you then have to ask yourself, okay, the inability to find the evidence, is it both material and pervasive? If it is not pervasive but material only, then you have to issue a qualified except for opinion. Then if it is both material and pervasive, then you have to issue a disclaimer of opinion. Now, I hope that when it comes to audit reporting, you guys are now home and dry, and when you get to that example, you're not going to be confused by anybody. Okay, you just have to know that there is a situation where we're going to have an unmodified opinion. All right, an unmodified opinion. All right. Then we also have an unmodified opinion, but with additional communication. This is what is called. This is also part of modified report. Okay, it has got an unmodified opinion, fine, but because there are some additional communications, then it becomes modified. Okay, the examiner might just say which of the following are modified reports, and they then say you just have to choose from the following descriptions. Okay, so if you see a description that says that this report has got an unmodified opinion with additional communication, obviously the report had to be modified, because a usual unmodified report doesn't have these make paragraphs, emphasis of meta paragraphs, and other paragraphs. Okay, it doesn't have all that. All right, as we have also indicated here, that an unmodified audit report shows that financial statements are true and fair, and the auditor does not use any additional communication paragraphs. He doesn't use any communication. Okay, no further communication, no make paragraph, nothing. When it starts to have the make paragraph and so forth, then the audit report itself has been modified. But that doesn't mean that the opinion has been modified. Okay, doesn't mean that the opinion has been modified. All right, the opinion will be modified if it becomes qualified. Okay, if it becomes qualified or it's got a disclaimer. Okay. When it becomes qualified or has got an adverse opinion or a disclaimer, then it becomes modified. Okay, I'm sure they just have to replay to understand what was going on. Okay, to understand what was going on. I still want to figure out something here. Okay. Now, the key automators, we said that these ones are related to listed companies only. Okay. There is this recent auditing standard, International Standard on Auditing 701. Okay. ISA 701, communicating key audit matters in the independent auditor's report, requires auditors of listed companies to determine key audit matters and to communicate those matters in the auditor's report. So, key audit matters, they are shortened as CAMs. Alright? CAMs are those matters that in the auditor's professional judgment were of most significance in the audit and are selected from matters communicated to those charged with governance, which means that you can't disclose a CAM in your auditor's report which has never been communicated to those charged with governance. Let's say the audit committee was never told about such issues, and then you highlight them in your report, then there could be some conflict. So these audit matters are taken from matters which have already been communicated. So they are just selected from those items. It doesn't mean that everything that you have communicated to the audit committee or to the board of directors or to other parties relevant to the governance of the company have to be communicated. No, you just have to select a few from those items. Alright. Auditors of non-listed entities may voluntarily or at their client's request include CAMs in their reports. The purpose of CAMs is to assist users in understanding the entity and to provide a basis for the user to engage with management and those charged with governance about matters relating to the entity and the financial statement. So each CAM should describe why the matter was considered to be significant and how it was addressed in the audit. So it means that whatever issue that is going to be highlighted as a key audit matter, it has already been solved. However, other parties would want to know how it was solved. Okay? How it was solved. Alright. Now, what are these CAMs? I mean, what do they include? These include areas of higher assessed risk of material misstatement or significant risks identified in accordance with ISA 315, identifying and assessing the risk of material misstatement through understanding the entity and its environment. They also include significant auditor judgments relating to areas in the financial statement that involve significant management judgment, including accounting estimates that have been identified as having high estimation uncertainty. Usually things like fair values, those ones are a bit subjective, and you just have to at least report them in the CAM and tell the shareholder how we have resolved them, right? Because managers might have their certain value and the auditor might be questioning this and that, and the way they addressed the conflict or they came to an agreement should also be disclosed. Then the effect on the audit of significant events or transactions that occurred during the period. Alright, this should also be highlighted. Whatever change or significant event that occurred during the year should be reported. Now, specific examples include significant fraud risks, goodwill, valuation of financial instruments, fair values, effects of new accounting standards, revenue recognition, material provisions such as restructuring provisions, implementation of a new IT system, or significant changes to an existing system. All these should be part of the CAM package. Alright? But remember, it's not only about listing the CAM, but you just have to also tell the shareholders how you had resolved those issues. Right? Now, please note, a matter giving rise to a qualified or adverse opinion or a material uncertainty going concern is by its nature a CAM. However, it should not be described in the CAM section of the audit report. Instead, a reference to the basis of qualified or adverse opinion or the going concern section will be included. Okay? We are saying here that when an issue, okay, is related to a going concern, to the going concern of a company, then there is already a merge paragraph, okay, merge paragraph, which deals with that. You do not have to report it both in the merge and as well as in the CAM section. No, it doesn't work like that. Okay, so a matter that is related to the merge, for example, is only going to be a reference to the merge paragraph. All right, and also other matters which might be linked to the to a qualified or an adverse opinion would be referenced to the basis of opinion paragraph. Okay, the basis of qualified or adverse opinion paragraph. That's where that is where they will be they will be reported. Okay. Now, if there are no CAMs to communicate, that's not an offense. Okay, but what does an auditor have to do? He has to discuss with the engagement quality control reviewer if one has been appointed. Maybe through those discussions, CAMs might be identified, or there might be need for a review of his work. Okay, because it's actually very serious to do an audit and fail to come up with cash, such a company would be a purely good company, but a very dangerous one, because even if it is a good company with everything in place, but sometimes there might be some lags in its internal controls, or even in the way they value. We are not saying that it is a must that comes should be there, but this is the reason why we are saying that there should be some reviewer of the work that has been done to ensure that actually or purely or totally there were no comes at all. Alright, we just have to be sure. Before we issue the auditor's report. Then communicate this conclusion to those charged with governance. Those charged with governance, ladies and gentlemen, should always be kept informed. Okay, they have to be alerted that we have found nothing that we can consider as a key audit matter. Then explain in the CARB section of the audit report that there are no matters to report. So the CARB section is mandatory. You can see that in this case the CARB is mandatory. Whether there is nothing to report, you just have to write something under that CARB section to say that, hey, there is nothing to report. There is no CARB to report. So you can see that for an audit of a listed company, the CARB should always be there. The CARB paragraph is always going to be there. If there is nothing to report, just have to explain in the CARB section that there were no matters to report as CARB. Okay, I'm sure we're done with audit reporting. We can clap hands for ourselves for being so fast. Now, for the next 10 minutes, we just have to talk about subsequent events. Okay, what is a subsequent event? It is an event occurring between the date of the financial statement and the date of the auditor's report, and facts that become known to the auditor after the date of the auditor's report. That is ISO 560 subsequent events. Alright, what are auditors required to do with regards to subsequent events? The auditors should obtain sufficient appropriate audit evidence about whether events occurring between the date of financial statements and the date of the auditor's report that require adjustment or disclosure are appropriately reflected in accordance with the applicable financial reporting framework. So that's the purpose or the objective of the auditor. They have to ensure that they have all the evidence. They are gathering all the evidence that all events which occur after the reporting date, which require disclosure or adjustment, have been properly taken care of. Alright? The auditor should respond appropriately to facts that become known to the auditor after the date of the auditor's report. So, you can see that after the year ends, that is the financial statement date. This is the year end, ladies and gentlemen. And the date of the auditor's report, this is the date, the normal date when the auditor signed their auditor's report. That's the date of the auditor's report. Okay? Now, so between the year end and the auditor's report, the auditors have to gather sufficient appropriate audit evidence about whether events occurring between the year end and the date of their auditor's report, which require adjustment and disclosure, are appropriately reflected in accordance with the applicable financial reporting framework. They should also respond appropriately to facts that became known to the auditor after their report. So which means there is actually work even after we have issued the report, our report. Okay, let us see why and how. Now, International Accounting Standard number 10, IS 10, should guide us in determining the nature of subsequent events. IS 10 events after reporting period identifies two types of event after the reporting period. There is what is called adjusting and non-adjusting. Adjusting, which means that FAs have to be adjusted. Simple, isn't it? Then non-adjusting, FAs do not need adjustment, but maybe disclosure. Okay, that's the thing. Now, adjusting events. These are events that provide additional evidence relating to conditions existing at the reporting date. Please, at this paper, in the paper AA, the examiner is much interested in you citing the appropriate jargon. Okay? You need to actually get used, to use this type of terms or this type of English, so that the examiners will be convinced that you are ready to go to the next paper. All right. So these adjusting events are events which provide additional evidence relating to conditions existing at the reporting date. So for an item to be an adjusting event, it has to convince us, or it has to be supported by evidence that such an item was existing, okay, or can be traced at the point at the end of the financial year of the company. Okay, let us just go down. Such events provide new information about the items included in the financial statements, and hence the financial statements should be adjusted to reflect the new information. Okay, so we are saying that this adjusting event should actually be linked, okay, should actually have links to conditions which existed at the year end. All right, for example, amounts received or receivable in respect of insurance which were being negotiated at the reporting date. So at the reporting date, there were some negotiations about insurance, okay, but we have recently received a communication 2 weeks after the year end that the insurance company is going to pay us. Then we can safely say that we have to adjust the financial statements, because by the time of the year end, there were such negotiations. So you can see that there were certain conditions which were existing by the reporting date. By the end of the year, there was something that is linked to that. Okay, allowances for damaged inventory and doubtful debt. At the year end, we had figures for receivables. Okay, but we have realized that about 20% or a major customer has filed for bankruptcy. Then obviously we have to adjust our receivable balance, because there are more doubts now that this guy is going to pay us. So there is need for us to create that provision. Okay. The determination of the purchase or sale price of non-current asset purchased or sold before the year end. This is also an adjusting event. Okay, this is also an adjusting event because the item would have been sold or purchased before the year end. However, the price, the knowledge of the price wouldn't have been available, okay, by the time the year end arrives. This might happen. Let's say maybe the guys who have been doing the procurement, they died. Okay, maybe they died soon after the item had been purchased, and there were no other records. Only after some incomplete record exercise, that's when the purchase price was identified, or maybe the supplier delayed to give us the invoice and so forth. So we determined the price just after the year end. So when the price came, we then have to make the necessary adjustments to the price of the asset. You can see that there should be some evidence at the year end for us to adjust the financial statements. Alright? Then agreement of a tax liability. Sometimes there might be some frictions with the tax authorities and so forth, where we'll be having squabbles. The taxman might say, hey, your tax should be this much, and we will be saying it should be this much. But by the end of the day, when we reach the conclusion, we then have to make some necessary adjustments, okay? And this might actually happen way after the year end. However, there is evidence that there were some tax squabbles which have been going on, right? And we know that tax is actually a continuous thing, and the evidence that the tax issues were there is actually very obvious, okay? You can't actually operate and say that no, there were no tax issues, so at the year end. No, tax issues are always going to be there, all right? They're always going to be there. So an agreement of a tax liability should also be an adjusting event. Discovery of errors or fraud revealing that financial statements are incorrect. This is also a straightforward adjusting event. Okay. Now, non-adjusting events. These are events concerning conditions which arose after the reporting date. Okay. If material disclosure is required in the notes to the financial statements indicating what effect the events may have. Okay, so only if material. Remember, we are guided by materiality. Okay, if material, disclose. And the examiners are happy if you tell them that you are aware that materiality is actually the issue, because that's the purpose of the audit. We only consider material things, although materiality is actually both in nature and amount. You just have to tell the examiners that. Sometimes it might not be material financially, but in terms of its nature, it becomes material. Okay. Also here, also have to consider the materiality of these issues again. Even on adjusting events themselves, you just have to consider the materiality of the issues when you are addressing your examination questions. Okay, such events therefore will not have any effect on items in the SFP SPO for the period. Alright, so there won't be any need to adjust figures and so forth. Examples of non-adjusting events according to International Accounting Standard number 10 include strikes, government actions such as nationalization. Okay, these ones, we can't say there was evidence of a strike, okay, when a strike was started 2 weeks after the year end. That one is actually not an adjusting event. It is not an adjusting event, it's a non-adjusting event. Then major changes in the composition of the group, for example, mergers, acquisitions, so forth, we can't adjust the financial statement because of that. Issue of new share capital or loan capital, non-adjusting event. losses of non-current assets or inventory as a result of fires or floods. This one always comes in the examination. It is a non-adjusting event. There were no evidence that fire was going to happen or was going to consume our stock. The purchases or sales of significant non-current assets. This one again is non-adjusting event. Now, the most contentious issues are the auditor's responsibilities. Auditors have a responsibility to review subsequent events before they sign the auditor's report, and they may have to take action if they become aware of subsequent events between the date they sign the auditor's report and the date of the financial statements are signed. Alright? The following timeline is helpful when considering subsequent events and the auditor's responsibilities concerning them. Alright, there is what is called an active duty period. This is the period between the year ends and the date the auditors sign their auditor's report. The date when the auditors sign their report. Okay, so between that period, they will be having an active duty of obtaining sufficient appropriate audit evidence. However, after the auditor's report has been signed and the financial statements issued and financial statements approved by members, here the auditors would be having what is called passive duty. Now, what is active duty and what is passive duty? Active duty means that the auditor is to perform procedures to ensure subsequent events have been accounted for appropriately. However, when we are talking of passive duty, this means that there is no obligation for auditors to perform procedures, but they must take action if they become aware of events which would cause a modified opinion. And we have talked about modified opinions. Alright? Now, events between the date of the financial statement and the date of the auditor's report. The auditor must perform audit procedures to ensure the client has complied with the correct accounting treatment of International Accounting Standard number 10, that is events after reporting period. If material adjusting events are not adjusted for, or material non-adjusting events are not disclosed, the auditor will ask management to make the necessary amendments to the financial statements. Now, when the question might ask you, what is the auditor's report? This is actually the first response the auditor should do. Okay, he should ask management to make the necessary amendments. Don't just rush to say he must issue a qualified opinion. Hey, if it was like that, then hey, no director was willing to become a finance director in any company, because that was going to be chaos. You just have to ask. That's the first thing you have to do. You ask management, may you please adjust? May you please make this disclosure? Then a written representation from management should be obtained stating that all events requiring adjustments or disclosure have been adjusted or disclosed. If management refused to amend the financial statement, the auditor should consider the implication for the audit report. To say an advisor or issue a qualified opinion, just have to consider the implications. Consider the implications. Sometimes there's no need to even issue an advice. Sometimes there might be an issue of qualified except for opinion. If the matter is material, the audit report should be modified with either, because it's not obvious that you have to issue an advice or opinion. It's not obvious. So with either a qualified or adverse opinion, depending on whether the matter is material or material and pervasive. Please beware. Please beware, because you no longer have any time left for you. You are writing exams in the coming week. You just have to be somebody who is not confused. Alright? Now, what about events between the date of the auditor's report and the date the financial statements are issued? The auditor is having a passive duty this time. Okay, he is under no obligation to perform audit procedures after the audit report has been issued. However, if he becomes aware of a fact which would cause him to issue a modified report, he must take action. So you might go on vacation, but remember that if something occurs or something come up which might cause you to actually change your opinion or to modify your initial report, or something that will lead you to come or to produce a modified report, then you need to take some action. The auditor should discuss the matter with management and consider if the financial statements require amendment. So you can see that you just have to consider approaching the management and then consider the financial statement impact. Request management to make necessary amendments. Okay. Perform audit procedures on those amendments to ensure they have been put through correctly. They are adequate, they are accurate, etc. Issue a new audit report, a new auditor's report. You can see that the auditor's reports, the auditor's actions or procedures are so easy, and they should be just flowing and they should be natural. They should flow and they should be natural. If management does not amend the financial statements and the audit report has not yet been issued to the client, the auditor can still modify the opinion. Sometimes it's actually good that you just have not to rush. Okay, you don't have to rush to issue these reports. Okay, just don't have to rush to issue them, because if you rush things, then there is a high chance that you might make some errors, or you end up giving a report today and then tomorrow you say, hey man, can you please cancel that one, drop it, we are having a new report. Sometimes it becomes some chaos, or it will actually embarrass you. So if you just do it with composure, you will discover that you will be on the right track. But we are not saying that you have to delay giving out the audit reports. Alright, so if management does not amend the financial statements and the audit report has not yet been issued to the client, the auditor can still modify the opinion, okay, silently, and say, hey man, we are lucky, let us just adjust this. Alright. Okay. If the audit report has been provided to the client, the auditor shall notify management and those charged with governance not to issue the financial statements before the amendments are made. So, because remember, the purpose of the audit report, the audit report is that it should enhance confidence in those users of the financial statement, So, the idea of stopping the issue of financial statements before the amendments, the idea of having the auditor stopping the issue of financial statements is that they would want to ensure that the shareholders are only going to be given financial statements which have got necessary information, or the rightful information. Alright, so the auditors would have to stop the directors to issue financial statements because they are no longer consistent with their report. Their report will be having new things now, which have to be in tandem, or which have to agree with what is being reported by the directors. So auditor should notify management. Alright? If they have already issued their report, they should notify management and those charged with the governance not to issue the financial statement before the amendments. Alright, now it might be confusing to say that management and those charged with governance, are these people different? Yes, they are different. Management, usually, is directors, okay? Directors and other senior managers. Alright, but when you talk of those charged with governance, we are referring to the boards, which include, usually these ones are executives who are charged with the day-to-day running of the company, but we refer to those charged with governance as the board of directors. The board of directors, this includes the names as well as the executives combined. Okay. We also talk of the audit committee. The audit committee, which is comprised of the NEDs usually. Okay, the NEDs. The audit committee is also part of those charged with governance. Alright. Sure, we are done there. So, if the client issues the financial statements despite being requested not to by the auditor shall take action to prevent reliance on the auditor's report. Okay, he might take action, like example, publishing the issue in the press. You can do that, or informing those charged with governance of the issue that management is. I've tried to stop these guys, but they refused. Alright, so he has to take the necessary action that can be done. But most of those things should also be legally informed. You just have to seek some legal advice in those areas because of issues that might be attached. Alright. Okay. Events after the financial statements are issued. Again, his duty here is passive, but he should also take some action if he becomes aware of a fact which would have caused them or caused him to modify his report. Okay? So, he has got no obligation at all to perform anything concerning the gathering of sufficient appropriate audit evidence. However, if he becomes aware of something that might cause him to modify his report, then he should take some action. The auditor should discuss the matter with management and consider if the financial statements require amendment. Request management to make necessary amendments. Management must also take the necessary actions to ensure anyone who is in receipt of the previously issued financial statement is informed. The auditor should perform audit procedures on the amendments to ensure they have been put through correctly. Issue a new auditor's report, including an emphasis of matter, to draw attention to the fact that the financial statement and audit report have been reissued. You see the other use of the emphasis of matter part. Okay. Lastly, if management refuses to recall and amend the financial statement, the auditor shall take action to prevent reliance on the report. Okay, I think we have done almost everything with regards to the duties of the auditors with respect to subsequent events. Now, the subsequent events procedures themselves. Okay, subsequent events procedures, what the auditor is to do with regards to subsequent events. According to ISA 560, the following procedures apply. Inquire of management if they are aware of any events adjusting or non-adjusting that have not yet been included or disclosed in the financial statements. Inquire into management procedures or system for identification of events after the reporting period. So you need to know how managers identify these. Okay, how do they do? How do they do, or what do they do to identify a subsequent event? What are their procedures? What are their systems? Which systems are in place? Etc. Then you have to read minutes of members and directors' meetings. Now, but in the exam now, the trick bit is that if you simply say read board minutes or inspect board minutes, the examiner is likely to give you a 0 because you have said nothing. Okay? You have said nothing. You just have to say review recent board minutes for evidence of any subsequent event after the year end. That one, in that way, you are bringing the reading of board minutes into context. If you simply just say read board minutes, then what? You're going to get a 0. Okay? Reviewing accounting records, including budgets, forecasts, cash flows, management accounts, and interim information. Okay? 4. Evidence of subsequent events or consistency of financial results. Okay? If there are a lot of disparities in the trend of these budgets or actual results, then you might also suspect that something could have happened this year. Why are the results so different from the previous periods? Alright? Obtaining written representation from management confirming that they have informed the auditor of all subsequent events and accounted for them appropriately. Remember, written representations are collected at the end, almost near to the date of the auditor's report. You must not sign the auditor's report first before getting the representation, the written representation of management or from management. Don't make that terrible mistake. They are collected before the auditor's report has been signed, but toward the end of the audit. Inspection of correspondence with legal advisors. This might also help you if there was any subsequent events or if there were any proof of provisions, legal claims, etc., which might be adjusting or non-adjusting. Review the price of non-risk areas and contingencies. Suppose your client has got a warehouse in Manicaland where there is prevalent of this cyclone in dies. There is need to actually review the press. Okay, you have to review the local press, that area, the Manica Post, for any evidence that there has never been some cyclone in the recent past. Otherwise, if there has been some cyclone, then probably the warehouse of your client would have been destroyed and the goods there or the inventory there would have been damaged, which means that their NRV would be lower than the cost, and there would be some need for those valuation issues. But in the case of subsequent events, we say that whatever cyclone that had occurred after the year end, that's not an adjusting, but it should be disclosed. If the inventory values are so significant, then they have to be disclosed. Okay. Reviewing relevant information which has come to the auditor's attention from the sources outside the entity, including public knowledge, competitors, suppliers, and customers. Sometimes when you are during a beer binge or in a golf course, you hear people who are gossiping about your client, about the misfortunes that have befallen him, and you just hear of those. You then have to just do your research as an auditor to find out or to review if such information is actually correct. So whatever information you get, just have to consult those sources and do your investigation. You can't just let the sleeping dogs lie. No, you just have to do the investigation and come up with the right conclusion. All right. Then inspecting after date receipts from receivables. This is actually a good procedure because it gives evidence of the recoverability of the receivables. So you need to check or to inspect those receipts. Okay, you just have to inspect the cash book, inspect the bank statement for such evidence of receipts. Okay, because they give you the valuation information about the valuation of our receivables. Because if they can't be recovered, if people can't pay, then it's either the receivables were overstated because there's no evidence that we are going to recover them. But if there is actually more evidence that people are paying in, then the receivable figure by the management could be correct. The receivables figure. Alright, inspecting the cash book after the year end for payments or receipts that were not accrued for at the year end. Okay, so we need also to inspect the cash book at the year end, okay, after the year end, for payments or receipts that were not accrued for at the year end. What do we mean here? If we are receiving payments from receipts which were not accrued for, it simply means that this will be new business. Okay, new business, because accrued for receipts or accrued for payments, this would have been relating to the previous period. Okay, they would be relating to the previous period. But if they were not accrued for, then they are new business, right? So that might also give some going concern assurance that the entity is continuing its normal activities. Its business activities are just running normally. Okay, running normally. Okay. I'm sorry. My phone was ringing. All right. Then you just have to inspect the cash book for that evidence to see if the entity is operating normally as it should. Okay. Then inspecting the sales price of inventories after the year end. All right. Why do we have to inspect the sales price? Remember the issue of inventory valuation. Okay, inventory valuation. According to IAS 2 inventories, inventory is valued at the lower of cost and NRV. Okay, not all. Some people make a mistake and say lower of cost or NRV. That one is wrong. It's and NRV. Okay, but at this level I'm sure you are now comfortable with the terminology. That's good. All right, so the reason why we have to inspect the sales price of inventories is to ascertain if the values claimed by managers in the financial report is actually what is happening. Okay, for example, let's say they were valuing a particular product at $200, but that particular product in the financial statements, okay, in the financial statement they were valuing this product at $200, but the customers are paying for this product at $150. So it means that the inventory was overvalued. Okay, the inventory was overvalued, and this is also most common in companies where the directors are paid on profitability, because if the inventory values are overvalued, it means that the profit is also going to be overvalued. Okay, when closing stock is high, then profitability is going to be high. All right, so that's the trick. So in this case, if the goods are now being sold at 150 instead of 200, which was their cost, then it means that the NRV has become 150. You see, it's become NRV, okay, the net realizable value. Okay, so the NRV is now lower than the cost, so we have to value the inventory as 150, which is the NRV. So there is need for a write down. The inventory has to be reduced by 50. Reduced by $50. But in the exam, again, like I told you, you just have to first calculate the materiality of the item. So how do you have, how can you ask a subsequent events question? All right, you just have to first discuss the issue from the question. All right, you have to discuss the issue from the question. For example, ABC Limited has recently had its warehouse destroyed by a hurricane, okay, in which its stock worth this much has been destroyed. The stock is the destruction of the stock is an adjusting or a non-adjusting event. In this case, the destruction of the stock after the year end is actually a non-adjusting event. Tell the examiner. Okay, the destruction of the stock is non-adjusting. It's a non-adjusting event. Then apply ISA 320 materiality. Okay, just have to use this RAP acronym. What is the RAP acronym? We are saying that if the item is a half percent of revenue, or 1% of assets, or 5% of profit, 5% of operating profit or PBT, okay, 5% of PBT, 1% of asset, or half percent of revenue, then such an item is actually material. Then you have to recommend the correct accounting treatment in order to avoid the modification. You tell the examiner that in this case, the directors should disclose, because this is material, therefore the directors have to make the necessary disclosures in the financial statements. Okay? Alright, to just wind up, I think we should do this question from the Kaplan Archive 8 study text. Alright. Murray case study, subsequent events review for the year ended 31st December 20x4. On 2 January 20x5, Gulf is, as a major customer of Murray Co., was placed into administration owing $211,000. On the 3rd of January, okay, remember all these are events after the year end. The year end is 31st December. Okay, so on 2 January, a major customer of Murray was placed into administration owing $211,000, and we say that this one is an adjusting event because a receivable has gone into liquidation. Okay, so this one is an adjusting event. Then on 3 January 2005, the sales director left the company. The sales director is suing Murray for constructive dismissal. If successful, the claim amounts to $280,000. Alright. The sales director left the company. He left the company on 3 January. The sales director is suing. So, can we say this one is an adjusting or non-adjusting? Okay, we can just put question mark here, but you can also just consider it a non-adjusting based on principle because it occurred on the 3rd of January after the year end. So it is actually going to be a non-adjusting event. Okay, that's a non-adjusting event, but depending on the evidence from the legal practitioners, if they tell us that yes, the value of $280,000 is likely to be paid, yes, it's a significant figure, we have to disclose it. Okay, we have to disclose. Alright, on 5 February 20x5, there was a fire at the premises of third-party warehouse provider, which destroyed all inventory held there. Approximately 1/2 of Murray Co.'s inventory was stored in these premises. The total value of inventory stored at the premises was $1,054,000. This is also a non-adjusted. The financial statements include a $40,000 provision for an unfair dismissal case brought by an ex-employee Murray on 7 February 2025. A letter was received from the claimant's solicitors stating that they would be willing to settle out of court for $25,000. It is likely the company will agree to this. Okay, the financial statements include $40,000 provision. So there is something here. There is evidence that something, occurred. Existed at the year end. So this one could be an adjustment. Okay, could be. Okay. Please also know that the issue of materiality matters. Okay, the issue of materiality matters. Okay, so we are given these figures. We then have to use these figures to calculate our materiality issues, the materiality thresholds. All right. Now, let's just review this simple solution so that we consolidate everything which we have covered so far. Alright, so the auditor will only control the directors to amend the financial statements for adjusting events if the adjustment is material. This is why I say that, ladies and gentlemen, please note that we are guided by materiality. Okay, whether it is a non-adjusting or an adjusting event, we should be guided by materiality of the issue. It should be material. Otherwise, we should not have to worry about it. When assessing materiality in the exam, it is sufficient to calculate materiality in relation to each measure individually, using the lower end of the threshold for prudence. If the item is material to one or more of the measures, then it requires adjustment. So, like for example, you may discover that it is material to assets, but not to profit, but not to revenue, or in that situation, as long as it is material to one of those, to profit before tax, or to assets, or to revenue. If it is material to any one of those items, then it is material. Just consider the adjustment. So, gold is asked was placed into administration after year end. Remember, we said we first have to discuss the issue. Then apply the accounting standard relevant. In this case, we are talking of subsequent events, so this is why we are talking of IS 10. But this type of questions might come to even other scenarios, or not related to subsequent events, but to other accounting issues. You just have to follow the same steps. Whether you are attending to to substantive procedures or other procedures, the examiner might have asked you to describe. Then you have to start with just have to write a brief discussion of what is happening, and then you have to apply the accounting standard to tell you what should be happening. Okay, and then you have to talk of materiality of the item, and then recommend the appropriate accounting treatment. Okay, appropriate accounting treatment. Okay, so this customer has been placed into administration after the year end, which provides evidence of the recoverability of the receivable balance at the year end. Therefore, this is an adjusting event. The total value of the balance is 211, which is 1% of revenue, 2% of total assets, 20% of profit, and is therefore material. The receivables balance should be written off, or an allowance for receivables created. You're done. You go to number two. We said it was a non-adjusting event. The sales director left the company after the year end and is suing. This guy is bitter. He's suing the company for constructive dismissal, which is an event that arose after the reporting date. Therefore, this is a non-adjusting event. The total value of the claim is 208,000, which is 1.3% of revenue, 2.9% of assets, and 26% of profit before tax, and is therefore material. As this is a director's transaction, it is also material by nature. The nature of the event and any estimates of the financial impact should therefore be disclosed. Okay, here the point I just want to emphasize is, suppose you would have calculated your materiality levels, and you discover that they were so lower than these ones. Okay, you will also go to disclose this transaction because it involves a common director who is a very senior person, so such transactions are considered material by nature. Then, item 3, a fire destroyed event after the year end, which is therefore a non-adjusting event. No matter how much that event is worth, it is a non-adjusting event. Okay, as the event was not destroyed at the year end. The total value of inventory stored at the premises is 1.054 million, which is 5% of revenue, 11% of total assets, and 101% of profit, and is therefore material. And the nature of the event and an estimate of the financial assets should be disclosed. Now, after the year end, a letter was received offering to settle a claim for unfair dismissal out of court. This is an event that provides evidence of the valuation of the provision at the year end and is therefore an adjusting event. The current provision is for 40,000 and the adjustment would therefore be 15,000. Okay, this is not material, being 0.07% of revenue, 0.15 of total assets. So there is no adjustment is necessary in this case. Why? Because of materiality. Materiality. Okay. Financial statements include the 40,000 provision for fair dismissal of debtors covered. Okay. And the claimant solicitors that they will be willing to settle out of court for 4,000. Okay. Alright, done there. That's fine. So I hope you guys are going to, do what you can do best in the exam. Alright, the going concern issues, we talked about them. Alright, but let us just touch these things here. Going concern is defined as the assumption that the enterprise will continue in operational existence for the foreseeable future. The period that management and therefore the auditor is required to consider is the period required by the applicable financial reporting framework or by law or regulation if longer. Generally, the period is a minimum of 12 months from the year end. In some jurisdictions, for example the United Kingdom, the period is a minimum of 12 months from the date the financial statements are approved. Now, significance of the going concern concept. Whether or not a company can be classed as a going concern affects how its financial statements are prepared. Financial statements are prepared on the basis that the reporting entity is a going concern. In National Accounting Standard Number 1, presentation of financial statements states that an entity should prepare its financial statements on a going concern basis unless management intends to liquidate the entity or to cease trading. The directors have no realistic alternative but to do so. So the directors have no choice but just to close the shop. Alright, so if that is the situation, then they have to prepare their financial statements on a breakup or liquidation purpose. The basis of preparation and the reason why the entity is not regarded as a going concern are disclosed. Assets are recorded at likely sales value. So when we are doing a breakup basis, then we just have to consider that we have to disclose the reason why we are preparing them on a breakup basis, and the asset value should be recorded at their likely sale value. Inventory and receivables may need to be written down, as inventory may be sold for a much lower price or may be scrapped, and receivables may not pay if they know the company is ceasing trade. Additional liabilities may arise, redundant costs for staff, the cost of closing down facilities, etc. So you can see that the going concern concept is actually very significant. Now, responsibilities of directors for going concern. It is the director's responsibility to assess the company's ability to continue as a going concern when they are preparing the financial statements. In order to do this, the director should prepare forecasts to help assess whether they are likely to be able to continue trading for the next 12 months as a minimum. If they are aware of any material uncertainties which may affect this assessment, then S1 requires them to disclose such uncertainties in the financial statements. When the directors are performing their assessment, they should take into account a number of relevant factors such as current and expected profitability, debt repayment sources and potential sources of financing. What about the responsibilities of auditors? ISO 570 going concern states that the auditor needs to ensure the financial statements are prepared on the appropriate basis. If the going concern basis is being used, they should obtain sufficient appropriate audit evidence that is appropriate or that is in support of that view. Where there are material uncertainties, the auditors must ensure that the directors have made sufficient disclosure of such matters in the notes to the financial statements. The auditor must consider the implication for their audit report. Now, there are many going concern indicators. Going concern problem indicators. Okay, for example, when the net current liability or net liabilities overall indicates, when we are having a situation where we are in net current liability or net liability, okay, this indicates an inability to meet debts as they fall due. Alright, and borrowing facilities not agreed or close to expiry of current agreement. Lack of access to cash may make it difficult for a company to manage its operating cycle. Defaulted loan agreements. So, like when you'll be reading a scenario in the exams and you see all these indicators, the difficulties the company is facing and so forth, then you can actually see or suspect that there could be some going concern problems emanating or hearing about this company. Okay. Now, events or conditions identified. If events or conditions are identified that may cast doubt, that may cast significant doubt, then your doubt shouldn't be any doubt, but significant doubt on the entity's ability to continue as a going concern. The auditor shall obtain sufficient appropriate audit evidence to determine whether a material uncertainty exists by requesting management to make its assessment where this has not been done. Evaluating management's plans for the future. Evaluating the reliability of underlying data used to prepare cash flow forecasts and considering the assumptions used to make the funds. Considering whether any additional facts or information have become available since the date management made its assessment. Requesting written representation from management and those charged with governance about plans for future action and the feasibility of these plans. So this is what the auditor has to do. Now, just to wrap it up, a question might actually come, which says that list the audit procedures which can be applied as part of a going concern review. Alright, so these are just examples. The auditor might analyze and discuss cash flow, profit, and other relevant forecasts with management. Okay, but you can see that the word forecast is taking prominence when it comes to going concern issues. So do not forget that word whenever you face a going concern question. Analyze and discuss the entity's latest available interim financial statements or management accounts. Okay, and you can also go on and say to determine if what they are forecast to determine whether their forecast or the given forecast is actually incorporating the results of the interim, or is consistent with the result of the interim financial statements. Alright, sometimes you may discover that the forecast is actually far much different from what is being explained by the interim financial accounts available. In that case, that would be a spell for disaster. Alright, review the terms of debentures and loan agreements and determine whether they have been breached. The reason why is that you would want to know, because you would want to know if the entity, is not going to face the refinancing problems. Read minutes of the meetings of shareholders, the board of directors, and important committees for reference to financing difficulties. Here we want to discover if the board is actually in distress. The board of directors could be in distress, highlighting that seriously or actually the going concern issues are apparent. Inquire of the entity's lawyer regarding litigation and claims. You just have to contact the lawyers and hear from them if there are actually serious and significant challenges facing the company. Those ones you can also read them on your own, and I'm sure you have been helped. And if you still find anything challenging, or if you need more help in your AA preparation, please just contact me. I will always be there for you. And like as I have already indicated here, these are the contacts through which you can get in touch with me. Alright, always be there, ready to assist you. This is my phone number. You can also send email there, or simply visit our website, that is www.transcarconsulting.co.zw. Please feel free to contact us, and we are there to assist you. Just as a parting shot, if you find this video helpful, please don't forget to subscribe and share or like this video, so that you will be doing the right thing, and we will also continue to do the right thing. Alright, also to ensure that other people benefit, so you just have to share it so that everyone would be helped in their Acca studies. Until we meet again, may the good Lord bless you. Thank you.